Let's get back to Goldman Sachs. Also, those numbers coming in. The earnings looks a little bit light, coming in $4.79 a share. Trading revenue coming in solid, $3.3 billion. Equities also coming in solid, $1.8 billion. The miss, though, had to do with investment banking revenue coming in $1.69 billion, different than we saw with JPMorgan. JPMorgan's advisory fees were a little bit soft, but its equity and debt underwriting was actually quite strong. So we're going to have to parse through some of those numbers to see where Goldman Sachs had the most difficulty in its IB unit. Joining us now from Columbia, South Carolina is Walter Todd, a Greenwood Capital CIO who owns JPMorgan. So what do you make so far in the last half hour of banking earnings so far?
Yeah, so I'm surprised by the Goldman numbers, given what we saw from JPMorgan a little bit earlier in terms of the investment banking. You alluded to that. I was figuring, given the IB number at JPMorgan, that Goldman would have a strong number, but it looks a little bit weaker, so we'll have to see what happened there. But I think with JPMorgan, it's really about kind of best of breed and execution. Really had a very solid quarter. I don't know that the read-through for other kind of regional banks that aren't as diversified as JPMorgan is necessarily great when you look at the lending and the loan growth that was pretty tepid. But I mean, overall for JPMorgan specifically is a very solid quarter. Yeah, and for JPMorgan also, and this is really going to come up for Goldman Sachs as well as Citi, is as the balance sheets expanded to sort of save on net interest income, how much risk do they take on? As a shareholder, what do you want to see? Do you want to see them take on more risk to make up in volume what they're losing in net interest margin? Well, I mean, to a degree, right? I mean, I think JPMorgan does a very good job of balancing that, taking on more risk for return. You definitely don't want to see them go too far out the risk spectrum, and that's, I think that's a risk with net interest margins compressing, particularly with the smaller banks, that they get into some other ancillary businesses that are more risky. But I think with JPMorgan specifically, that's not a really concern given the management team that you have there and the history that you have with the company. We're also getting some color from the press release from Goldman Sachs, David Solomon, saying that he's noting a mixed operating environment. He does say they're still trying to execute on priorities like investing in important growth opportunities in their existing and new businesses and delivering for their clients. But still, it feels like a mixed operating environment is what he highlights, and their ability to deliver results within that environment. So earnings coming in a bit light, but it's the investment banking revenue number that came in light that is sort of catching everyone's eye here. Joining me here in New York is Alison Williams, Bloomberg Intelligence Senior Banks Analyst. Alison, you've had like 3 seconds to read through this. So you have a read through so far yet on Goldman Sachs?
So I guess the first take is that fixed income did not match that stellar jump that we saw at JPMorgan. So I think that's the negative. We'll want to hear a little bit more about what's going on there. JPMorgan has been, I think they're the biggest in the business. They've been gaining more share than others. It looks like that continues this quarter. Although equities trading looks like it's a little better. So that could be a positive. They also had a strong quarter last quarter. Keep in mind that they're probably gaining share in the wake of the Deutsche Bank sort of shakeup. However, JPMorgan's was light, and investment banking fees also look like they were a little bit light. Yeah, so what do we make of the whole investment banking revenue being down 15% for Goldman Sachs, but then delivering well for JPMorgan? And I asked Walter this too. I mean, how much of that is them taking on more risk versus not? Is that what the takeaway, or we don't know yet? So I think, first of all, the numbers can be influenced by, one or two big deals. It can be influenced by, what happened the quarter. So we'll want to dig in a little bit. Mm-hmm. Keep in mind that, Goldman earns more revenue from M&A than anybody else. Mm-hmm. So we're going to want to look at that. On the debt side of things, Goldman is really, they're sort of one of their best businesses is the leveraged finance business. So that was not one of the better performers this quarter. The better performers were really investment grade, high yield underwriting, and that's where JPMorgan is super strong. So I would say these numbers probably bode well for Bank of America, but perhaps not for a Morgan Stanley from that respect, from a debt favor. So I'm
going to bring up the dreaded WeWork. I mean, legit, do we have to factor WeWork into this color?
I think the key thing for WeWork is what does that tell us about the outlook for equity fees, and not necessarily fourth quarter, which is not the biggest quarter for these banks, but as we think about 2020. is there a sign that the IPO market could be slowing? And on the debt side of things, while we did see, certain areas very strong this quarter, especially high yield, it's sort of a mixed outlook for the fourth quarter, according to our credit strategist. And then if you look at what's happened to refinancing, we've really pulled some fees forward. So a strong quarter in debt fees for some players may mean sort of less opportunity for next year.
Yeah, I'm just trying to find net interest income also for Goldman Sachs. I'm not finding it quite as yet. But what did we learn there from JPMorgan so far? Because they did surprise to the upside. Part of that is expanding their balance sheet, which implies taking on some more risk.
Correct. And so that's less of a factor for Goldman. I think, for Goldman, it's really the longer story of building out their consumer business. They're sort of at a very different starting space. They have a big white space in terms of gaining. So it's more about, what's happening with the Apple Card, what's happening with sort of the growth in that business. Whereas for JPMorgan, where net interest income is much bigger source for them, it looks like their guidance is probably about in line with what they gave us most recently. What we haven't looked at yet is, are they able to offset some of the margin pressure due to mix? Are they growing their consumer loan book and gaining share in that respect? We did see sort of a pickup in consumer loans and some of the government data. Are we going to see that at JPMorgan? We'll be looking at Wells Fargo also later on today. Obviously, they have their own constraints. So
just to get some more color here, so for Goldman Sachs, they're investing in lending net revenue. If you take a look at their record net interest income, they actually, in debt securities and loans, it hit a record of about $891 million. So a little bit more color there. Walter, when I take a look at banks, you could have JPMorgan now opening at a record high. Do you buy them more here? Do you just hold for the ride? What do you do?
Yeah, I think it's important to recognize that despite a very good quarter from JPMorgan, who is operating at a very high level, it's a very difficult operating environment overall for banks in general, with compressing net interest margins, low yields, et cetera. So I don't think you want to extrapolate that to necessarily other banks. So we hold JPMorgan. We're comfortable with that one. We also hold Bank of America. We'll see what they say tomorrow. But I think in general, you don't want to make a blanket statement and buy banks across the board, because it is going to be kind of unique circumstances to each company.
And Alison, I want to point out for Goldman Sachs, talking about their markets and card lending, their provision for credit losses actually was up 67% on a year-on-year basis. Do we look at that as like a good thing?
We would look at that as they're growing their portfolio. They need to.
So we like that.
We like that. I mean, I would look at that as just sort of math. They're growing that portfolio. They need to grow the reserves just as much. They need to grow that provision just as much.